I'm an engineer by training, and so engineering discipline tells us to start with first principles, and so the easiest thing to do is to start by defining what is value and what is a proposition, right? So if you turn to Merriam-Webster, right, this is the answer that you get. I think it's a relatively simple explanation, right, that a value proposition at the end of the day really is some sort of offer that's a fair exchange for some good. Right? And so now the question becomes, how do you describe that good in a way that is appealing and enticing for a prospective customer? And I'm going to build this hypothesis throughout the talk today that the moral equivalent of the who, what, where, when, why, and how are these 5 elements. Right? So it's the articulation of the primary purpose of the product or service. It's identifying the target audience. It's capturing the significance to a prospective customer. It's identifying and specifying the category in which you compete. And it explains the uniqueness of the product or the service. Now, the reality is all 5 of those statements sound quite obvious. Unfortunately, it's deceptively simple, right? And so anyone who has gone through the exercise of actually trying to write out your value proposition has probably found that it's much easier to list these 5 properties that should apply than it is to actually figure out how to translate them into a real-life circumstance. So what I wanted to do is I thought maybe I would just kind of double-click on these 5 and spend a little bit of time talking about what are the questions that you want to answer in thinking about each of those 5 elements. So if we start with purpose, this one is probably the easiest one to describe, and for some reason entrepreneurs get it wrong most. And at the core of it, it's really answering the question, what does the product or service do? Right? And the place where I think entrepreneurs often go awry here is they spend lots of time, particularly in the technology arena, where most of them are engineers by training, and I can say that as one, end up describing the product, right? So they say, well, I've got this widget, right, and here are all of the neat properties of the widget, right? And what they forget to do is then translate why those properties actually matter to anybody. Right? It's sort of well, I've laid out the properties, and therefore you should be able to draw all the logical inferences of why you care. Right? But if you think about it, think about the last time you read an ad. Right? My bet is you read 5 or 6 words of the ad, and then you quickly turned the page in the magazine. Right? You had to capture your attention very, very quickly. And so when you talk about what is the purpose of the product, you need to give a very succinct summary and statement that really captures the imagination of the audience that you're addressing. So the second part to it is to identify the target audience, right? And this is sort of the question of who cares, right? Who's going to go buy this product or service? You can certainly start to think about some of the quantifiable elements of this, right? A TAM analysis of some sort, or understanding kind of how many dollars are spent in that particular category or on that particular problem. So there are ways to put some parameters around that audience. But I will submit that you want to be able to define who is the audience you really care about servicing. Right? That's going to have implications throughout the rest of the value proposition statement. And then I'm going to argue that the value proposition effectively becomes the roadmap for building out the overall business plan. Right? And so understanding who the customer is determines a whole lot of other elements to your business strategy. Yeah?
How important is it to focus more on the key decision maker rather than just the general approach?
Yeah, no, I think it's an important distinction. And it's probably particularly pronounced when you talk in terms of enterprise software. When you think about selling to an end consumer, the ultimate decision maker is probably the same individual that you are messaging to. But in the enterprise context, that's actually often very different. And in fact, it's complicated by the fact that the person that you initially message to is probably not the person who ultimately has budget authority. And so thinking about and understanding who each of the stakeholders are will play a role in how you craft the ultimate value proposition. And sort of the most effective value proposition statements I've seen when you're talking about a B2B sort of business ends up crafting the value proposition in such a way that some of the elements speak specifically to the initial hook into the organization, and others speak to the person who's actually going to pay for it. Right? And so being able to understand each of those stakeholders ends up being a pretty important distinction sort of as you get to the next level down. Okay, so the third element then I think is significance. So what are the key benefits? This is the enumeration, right? So when somebody said, write the value proposition, this is probably what you immediately thought of, right? It's the list of the 25 things that this thing is going to do for you. And implicit in this is a ranking, right? The reality is that you probably can come up with 25 great things that your new startup is going to go do. But only 2 or 3 of those are really, really important. And so some of this exercise is making that list and then starting to figure out which ones are right in the priority order, right? And to the point of the earlier question, sort of which ones do you then want to ultimately select to talk about, whether you're talking in terms of your marketing message or your sales process or things like that.
So what's a useful exercise is to describe life before your solution arrived and then life after your solution arrived to the particular audience you're talking about.
Exactly. So that's the second bullet here, is exactly that. One of the exercises that I often do, remember I said that I get a lot of entrepreneurs who are engineers, and so they tell me what the product is. And the easiest way to tease out the answer for them of what is the value proposition ends up being exactly what you described, right? It's walk me through the day in the life before, walk me through in a day in the life after, and then understand kind of what those deltas were. The third sort of part to significance, I think, really kind of speaks to this question around why does somebody care? But it really is the magnitude of the caring, right? And then the sort of analogy that people draw is this question of, is it a painkiller or is it a vitamin, right? So a vitamin is something you know you should take, but you probably forgot every morning. And a painkiller is something you absolutely need by 5 o'clock, right? So you want to make sure that whatever the product or service is that you're delivering, if you're a startup, I'll submit it has to be in that second category. It has to be a painkiller, right? There's just too much noise to kind of capture the imagination and attention of a customer. If you don't have something that is so compelling, they absolutely need to buy it. And I think that plays a role in understanding which of these kind of list of value propositions are the ones you pick to focus on, right? Because it's the ones that are so significant that it jumps off the page that, in fact, the customer probably knew they had the problem and actively went searching for the answer, as opposed to you're having to evangelize why your product or service even mattered to them to begin with. The last piece to it, which is by far the hardest to do at kind of the very beginning, but I think is something that you can add to the story over time, is the quantification of all of this, right? And in the enterprise context that I spend most of my time, that's oftentimes termed around some sort of ROI analysis of how many dollars can be saved ultimately, or how many dollars can be generated. But it's some sort of quantitative metric, right, that allows you to validate that the significance actually is significant, right? And it puts some anchors around it. This is something that's really hard to do on day one. So if you've got a neat idea for a company you want to go start, you probably don't have an idea of how to quantify all the benefits yet. But it's something that you can layer into the story as you start to build out real-life customers. The fourth one is category. And here, this sort of speaks to a belief that I have about how people think about the world. I think a lot of people use categories as a simple heuristic to think about buckets of things, right? It gives you sort of a mental framework to say, well, that's sort of in this bucket, right? And I can think about this whole bucket in a particular way. When you think about how to build a startup now, and certainly it's true in the technology arena, but I think it can be generalized as well, you need to think about what category do you want to be a part of. Right? And the two options here really are some existing category, right? Hopefully one that has favorable attributes to it, right? There are lots of categories that have unfavorable attributes, and you probably don't want to associate yourself with those. But the other option is to create an entirely new category. I think there's this natural temptation to say, well, mine is totally unique. I have something that no one has ever thought of before, and it's so different, I'm in my own category. And I'll argue that that's actually the hardest route to take, because now you have to convince people not only of your company and your product, but you've now got to convince them that this is a category as well. And so you need to think through kind of what those trade-offs are. But it's an important part to this value proposition because it anchors the discussion around some reference point that people already understand. Whether that's sort of the intersection of two things that's now this new category, or it's something that is already existing that people know about. And then the last element to the value proposition is the uniqueness, right? This is sort of the differentiation of what makes you different. And there are a few dimensions to this that I think that are important. Obviously, you want to kind of differentiate yourself relative to the status quo, right? So what are the substitutes that are available today that people are already perhaps using to solve this problem, back to kind of the day in the life example. But you need to somehow sort of tease out kind of what is unique and different about this. But I'll argue that what's important here is as much the axes that you pick as the actual elements of differentiation. And the reason is this sets up sort of the long-term vision of the company. So over time, right, the goal is to build a sustainable company, right? It's not to sort of differentiate your product initially. And so if you're going to build a company that's sustainable, you need to think about what are the sustainable attributes over time, right? So in the world that I live in, lots of people tell me, well, it's really hard technology to build, right? And the reality is that, that may be true, but Microsoft can throw 1,000 engineers at this problem, right? Or Google can put 2,000 engineers on the problem. Is it really so fundamentally different that that's really the secret sauce here, was that you just worked at it for a while? So the same can be applied to a lot of different contexts to think about what are the long-term basis of competition in any given product market. All right, so where do you go with this, right? So once you've kind of answered these sets of questions around these 5 dimensions, right, other than sort of an interesting academic exercise, what do we now do with it, right? And I think the first application of it ends up being around the elevator pitch. You hear the elevator pitch discussion and vocabulary come up primarily in the context of investors, but the exact same thing applies when you're talking to a customer, right? So if I grab you on the walk from here to my car and I want to sell you something, I need to be able to explain pretty succinctly what it is that I'm offering you, right? Back to value and proposition. I got to be able to describe that for you in relatively short order. And so, I will use this Mad Libs exercise as sort of a way to kind of force it into a sentence. Obviously, it doesn't have to be a single sentence, but I think it gives you a reasonable construct for how you might go about writing an elevator pitch, right? ABC Corporation provides, category, solutions to, target customer, for, purpose, which allows them to benefit by leveraging unique technology, right? And that ends up being a really short sentence. It's probably really hard to do, because my bet is that you've got an answer that is 2 or 3 paragraphs long for every single blank, right? And the trick now is, how do you get that down to 2 or 3 words to describe it, right? Once you've done that and iterated on it a few times, you now have your elevator pitch. Everything that follows, right? So floors 1 through 5 end up being this first sentence, right? 6 to the top ends up being all of the supporting detail. And force yourself to put all of the rest of the information, the validation of customers, the partners you've talked to, the additional reasons, perhaps the ROI, all of those other elements now become secondary and subordinate to this first sentence, right? This is the most important sentence. So if the person you're talking to only remembers one thing about you, hopefully they'll remember this one sentence. All right, so once you've crafted the value prop, right, mostly because I'm on the venture side, I get the question all the time of, well, how do I convince an investor that they should invest in this, right? And I'm going to answer the question in the context of a VC in particular, but I don't think VCs are all that different than any other investor that you might try to address. So the first part of it is that the value proposition exercise that you've just gone through actually forms the cornerstone for the entire investor value proposition as well, right? It's the teaser that got you the initial meeting. Right? It's the fundamental aspect of the executive summary that you sent. It's the story arc for the investor presentation overall, right? And it ends up becoming the cornerstone of the investment thesis. So when I sit in a partner meeting and I try to convince my partners that I want to go invest in some company and I need to get their buy-in to make that happen, I'm going to rely on that value proposition as the reason to do it, right? And I think the same thing can be generalized to any investor. Having said that, though, that same moral equivalent of the who, what, where, when, why, and how can be applied in the investor context as well, right? You just change sort of the descriptors around each of those 5 elements. So is the purpose worthy of assuming startup risk, right? Remember that in the venture business, call it 7 out of 10 investments fail, right? So it means that the 3 that succeed had better be really good to make up for the mortality on all of the others, right? So is the purpose worthy? The second is the target audience large enough? Right? So, or have you narrowly defined the audience that you're addressing to be so small that I don't plausibly believe that you can build a big company here? So make sure that it's a large enough audience. The third one is the significance valuable enough to customers? This goes back really to my painkiller discussion, right? Is it a painkiller? The fourth is in an attractive category for investment. So the discussion we just had, there are certainly some unfavorable categories that if I said it is in category X, every one of my partners would shake their head and go, no, move on, right? So you need to understand that. And then the fifth one is, what is particularly unique about this startup, right? And as difficult as it is to hear, I can assure you that for every business plan that I've seen and funded, I've seen 10 or 15 others that were attacking the exact same problem, right? And as much as we'd all like to think that we're truly unique and have unique insights that no one else in the world has come up with, the reality is that's not true. And so what is it that is unique and special about this one project that as an investor commands your attention? Okay, so let me just ground this in a real discussion of a real company, which I think might make some of it come a little bit more alive. So I picked a company called Kimby Systems. It's probably as unsexy to anybody outside of the tech space as they come, but it had a fantastic outcome, so that's why I like to speak about it. This particular company, at a high level, is in the test and development automation space. So if you've ever written software before, you know that one of the processes that you go through is you do this quality analysis to figure out whether the product is functional or not. This particular product completely automates that entire process for you. So you can imagine all of the benefits that come from that around reduced labor, improved product quality, et cetera, et cetera. So the way these guys came up with this idea is this guy Wilson, at the time he was VP of engineering for an organization. And he had built a series of tools that helped him run his engineering organization and automate some of the testing that he was doing. And one of his friends came up and asked for a copy of it, and so he gave it to him. The second friend came up and asked for a copy, and so he gave it to him. And about the third time that he was asked for a copy of his software, the light bulb went off, and he said, wait a sec, maybe there's actually an interesting business to be had here. And so he gave it some thought, and he went and found his partner, James Phillips, who co-founded the company with him. And together they decided that they wanted to go start this company. And so they started the company in 2004. I met them in late 2004, early 2005. I was introduced by a mutual friend, and they had decided that they wanted to go out and raise a Series A financing. Now, just to give you the spoiler, I did not end up investing in the Series A because of category. It's in the test and development automation space, which is about, as I said, as unsexy as they come. And so I wasn't sure that the financial returns were actually sufficient enough to make it worth proceeding. And so I passed on the Series A. I ended up investing in the Series B, mostly because they had built enough of a product that they convinced me that there was some magic there that they could really go after the ultimate vision. The interesting kind of footnote to it is we sold the company 5.5 months after my Series B investment to VMware, and it now forms the basis of all of their automation suite. So great outcome. But I use it as an example because it probably is the best investor pitch I have ever seen. This is the value proposition, and if you read through it for just a second, you'll see how they applied the Mad Libs exercise effectively, right, to each of the core elements. And my bet is that even though you don't know a bunch of the jargon or may not know all of the jargon, my bet is that you've got a reasonably good idea of at least why this is sort of an interesting business, right? And you could at least map to, does this apply to me or not? So that's the elevator pitch that got my attention initially. And this was the second slide in the slide deck. It was the value proposition. And so he was trying to articulate to me why it was a customer cared about this. And I'll let you kind of in the backdrop read through sort of each of these bullet points. And I think the thing that will hopefully stand out in your mind as you read through them is every one of this speaks to a business reason for somebody wanting to buy this product, right? Now, it's missing the quantification around this. It was a Series A company, and so he didn't actually have any real customers other than the ones that he'd given it to. So, he didn't really know sort of how much it improved each of these elements, but there was a good basis to believe that it did. So this was slide number 2. And I think slide 17 was this one. This was his last slide in the slide deck, investment highlights. And if you walk through it, you'll notice that it actually addresses basically all 5 of my who, what, where, when, why questions, right? And sets it in a context of why does an investor care? If we take that as sort of the backdrop, what I thought I would do is kind of step back a little bit and just talk more generally about what do venture folks look at and what are some of the properties of successful companies, because I think that colors how you think about the value proposition statement, particularly to investors, but more generally as well. So the first part of it I call my motherhood and apple pie spiel, right, which is what do VCs look for, and it's pretty simple, right? It comes down to people, market, and product. I think you will find wild debates between the first 2 on the list in their sequence, but to the discussion we just had, the third one is by far the third one. And as much as that pains me, I'm an engineer, I love my discipline, but we are now necessary but far, far from sufficient to build a real company. And so the focus for venture guys ends up hinging primarily on the first two, people and market, and you'll find a lot of debate over the actual order between those. I personally put market first because I think you can find great teams who will figure it out over time as long as you're in a market that gives you enough degrees of freedom. But there are an equal number of VCs who believe very strongly that you find great entrepreneurs, and they'll change the market if they need to in order to get to a successful outcome. But the three sort of, at a high level, it's exceptional entrepreneurs, large, rapidly growing market, and innovative and differentiated product. This part of it, clearly applies to venture-backed tech companies. But, remember, we think about a very small sliver of the universe, right? The vast majority of entrepreneurial activity in this country has absolutely no basis for venture investing. And so, the things that we look for, right, are probably somewhat unique, but I would argue that, to some varying degree, all three of these elements end up being pretty key for any entrepreneurial activity. The fourth one, which almost invariably gets left out of the discussion, and oddly enough ends up being the one that companies stub their toe on the most, is the go-to-market elements, right? So it's how do you connect the dots? If you have the first three and it's perfect, but you have no idea how you're actually going to get it to a customer somehow and sell it to them, right, it doesn't really matter. And so the fourth thing, right, this go-to-market strategy, ends up being the one that everyone overlooks in the discussion, but it's always the one that causes the company to fail, right, with the exception of sort of, one of the first three just being, completely out there. So if I spend a little bit of time kind of looking at each of these three, sort of what are the qualities that, when I'm looking at an investment, signal to me that it's a really interesting opportunity, and for you as entrepreneurs, the things that you want to get across in your presentation, right? The first part of it starts a team, and the observation here is that the team is built around a couple of key people, and that's universally true. There almost always are one or two people in the company that ultimately define the success of the company, right? In the context of the tech world, it's usually the rock star engineer or two, combined with the one or two people that really understand the business better than anyone else. But it's always that core nucleus. And somehow that doesn't change. So you can go to almost any public company even in the tech landscape, and my bet is that if you ask internally, you'll find 3 or 4 people that are the root of the company, right? Everyone else is still contributing. It's not that they are useless by any means. But there are a few people that really determine where that company goes. And so identifying early on in thinking about funding a company who those people are is absolutely essential, right? Because you're looking for those rock stars. So what are some of the properties to those rock stars? It's sort of one of these things that you know it when you see it. But let me try to sort of identify what some of the common qualities are. The first one is that they're smart and passionate. They generally have very unique insights. They're driven to succeed. And here there has to be a drive that is unwavering. The reality is that if you actually sat down and logically analyzed the chance of success, no one would be an entrepreneur, right? You'd have to be insane. You would, right? I mean, the chance of failure is so incredibly high. And so in order to power through all of that, you have to have an uncompromising drive to build a company. The third one is that there's got to be a unique insight, right? And we spent a bunch of the time kind of hovering around this point in the discussion so far, right? And I think there's this general belief that, well, in the tech world, that somehow has to do with product and technology. And the reality is that it often doesn't, right? It could be around a deep understanding of customer, and I think the Kimby example is actually a really good example here. It was their insight because they had been the customer, right? They built the product for themselves, right? They really knew what the customer needed, and that was what set them apart, right? That's why no one else was able to build that product before. The second part, right, could be technology, could be process, right? So perhaps you have a unique process. That might be semiconductor process. That could be a business model process. And then the last one is you might have a business model innovation, right? SaaS used to be a business model differentiator. Fourth, desire to recruit a world-class management team. I have this theory about people. There are A players, B players, and C players. A players love to hire other A players. B players love to have somebody that they're above, right? So they go out and they hire a lot of C players. The problem is B players can hire C players way faster than A players can hire other A players, right? And so you end up in this death spiral pretty quickly. You have to have a commitment to only hire A players, right? So the general rule of thumb is I'd only want somebody that was better than me, right? I need to be the dumbest person in every room, right? And if you use that as sort of the bar, you're constantly raising the average in the company. Next one is you need to know what's missing on the team. I think there's this temptation to sort of put this front up to investors and say we've got everything, right? It's sort of, well, let me take the list of titles and figure out who is going to cover each one of those so that we've got them all covered. And the reality is, we don't want that, right? We'd actually much rather there be some candid discussion around, hey, we don't have this skill set. We got to go find that person, right? As long as that core nucleus is there, it doesn't really matter beyond that. The other piece to it, right, that I think is related is this weird problem around titles. People seem to get hung up on titles for bizarre reasons. I got to tell you, I would much rather see a business plan that had everyone called a director and then sort of this discussion around maybe we'll need better people, maybe we won't, than to have everyone as VPs and knowing that several of them actually aren't, right? So think about kind of how those things influence how investors view you. So the last thing that I'll note on team, and this again is specific to the venture context, the VC is trying to size you up to figure out whether you're somebody they want to work with for the next 3 to 5 years, right? And the hope is that you are doing the same. The joke that I always make, right, is that it's sort of like marriage, that you're marrying your VC. The rejoinder to that, of course, is you can't actually divorce your VC once you pick them. So market. So what's important about market? It's all about the size of the market and how fast it's growing. I would argue that the bar that most venture folks apply is that it needs to be a $1 billion plus market that you're going after. And the reason is simply a pattern recognition of what percentage of the market are you likely to be able to get. And so venture folks sort of apply this heuristic of you might be able to get 10% or so of the market over time. And so it needs to be a $1 billion plus opportunity to justify it. Second element, we've spent a lot of time already talking about the pain and the fact that it needs to be an acute pain. We talked a little bit about the fact that it could be quantifiable and some of the ways that you could go about describing it. I think the last point was one that we did not talk about before, and that's the observation that it actually matters where the market is going as opposed to where it is today. And so part of the story needs to be how does this unfold across the dimension of time, right? So you may have a story right now, but what does that look like 2 years from now or 3 years from now or 5 years from now? So what are some of the elements here of the go-to-market plan? The first part is the marketing strategy, right? So how do you get the message to your customers? And obviously this varies pretty widely by category in which you compete. But there are a whole lot of sort of constituent elements here. One that I think you ought to make sure to think about in this context is partners, right? So how do you get partner leverage somehow in your business model? It is relatively rare that a small startup goes at it alone and succeeds without some giant befriending them along the way. So in my Kimby example, they were befriended by both VMware and Microsoft. That was the unfair competitive advantage that they got very early in their life. Second part is the sales model and distribution. And so consumer, perhaps there's less to be discussed here. If you're talking about enterprise software, there's a whole richness of options to choose from. But these are, having them well thought out and making sure that it's a coherent plan makes a lot of sense or is necessary. And then the last piece is sort of the pricing, right? It's sort of how do you monetize it? Again, the range of options is large. What venture folks are looking for here is not that you have the answer, but that you've got several hypotheses of what the answer might be and a systematic way to go prove them out, right? So in the consumer context, you might say, I think there are 4 different revenue streams, and here's how I'm going to be able to turn each one of them on, and here's sort of the key metrics to know whether it's working or not, right? And that's a sufficient answer for an early stage company. The next part on the how do you deliver it to market is the financial and operating plan. And the test here is not do you actually have all the answers. It's simply a reasonableness test, right? Does the story hold together in a way that it actually makes sense, right? Or have you crafted this whole thing, and now when you put it on paper, you realize that your customer acquisition cost is $500, and you think you can get $100 out of them, right? And suddenly the model no longer works, right? So it's really a reasonableness test to see whether you can put something together that holds together and is consistent with the rest of the story. The reality is we recognize that no company will actually successfully hit the model that you give to us on day one. If you do, that would be awesome. And congratulations, you're one of the first. All right, so product. So the first observation here we kind of already talked about, and that's that positional advantages are rarely sufficient. I can't tell you the number of times that I've seen a pitch that says we have a first mover advantage. And I always challenge the entrepreneur to cite me an example in technology where first mover won. You may be able to come up with one. I'm yet to find an entrepreneur that's fast enough on their feet to come up with one for me, but you might. But it's pretty rare. So rather than relying on that, instead focus on some sort of capability based. And we've already talked through sort of what some of the range of options there might be. Technical differentiation seems to be the one where people have traditionally hung their hat the most. I think that's moving towards some sort of innovator's dilemma, where there is a belief that the incumbents are unable to reach a particular market. Perhaps it's a business model shift. Perhaps it's something else that keeps them from following you. Clear and succinct value proposition. We've spent a lot of time kind of already talking about that. So the one sort of caveat that I will apply to it as it applies specifically to product is the 1.0 release. Right? So the other problem that you can run into is, I call it the Cadillac problem. Of you come in and you say, well, here are all of the things it's going to do, and we should have it ready for you in 8 years. Right? And that's just not acceptable. Right? You want to get out there and you want to start getting feedback earlier to figure out whether or not you're heading in the right direction. It's entirely possible that you picked all the right features and in 8 years you'll be spot on, but I'd much rather deliver something in 6 months and then iterate and then deliver something else in another 6 months and continuing that refinement process. So the test for venture guys is, what's the minimum set in the 1.0 release? And the test that I always ask people is to go through the exercise of pose to yourself, what is the fewest number of features that I need to provide to get money in exchange? Right? And as long as that's the smallest unit, the smallest quantum of value you can deliver, right, that's what should be scoped into the 1.0 release. The third sort of point here around leveraging trends and standards, it's much easier as a startup to ride a tidal wave, right? So find something that's wildly successful and figure out how to latch yourself onto it. If I go back to the Kimby example, they rode the virtualization wave, right? You had to be hiding under a rock someplace in IT to know why virtualization was important over the last 3 years. And they were able to sort of attach themselves to that. And it really didn't matter sort of whether they did anything wrong, right? They still enjoyed all the benefits of that category and riding that standard and wave. The key to thinking about your operating plan is how to schedule removal of risk from the business. And what you want to do is you want to link that to financing events, right? So each individual round of financing should be predominantly around removing one key element of risk in the business, right? So if you are a consumer business, the first risk I would submit to you that matters is customer acquisition. Can you get anyone to come to the site, right? The second one might be engagement. Once I've got them there, can I get them to do something on that site? And then the third one might be, once I've got them there and doing something, can I figure out some way of extracting money, either from them or some third party because they're there, right? So that would be an example of a progression of risk reduction. And I think you want to go through that same exercise irrespective of the product category. So the classic example of an innovator's dilemma would be a condition where a business model shift is required. And the usual example that people cite is that there is some giant in the sector in order to change their business model, actually has to effectively get rid of the existing business. So an example, right, that was cited earlier was sort of this move to SaaS. So if I have a legacy business, right, where I'm out elephant hunting for multi-million-dollar enterprise deals, and I probably have a 20% annuity stream on maintenance from my existing customers, to suddenly shift all of that and go sell SaaS software, right, as a subscription business, so I don't get paid up front, I get paid in this annuity stream over time, right, is going to really disrupt my existing business because I've got a sales force that's comped this way, I've got a marketing machine that's set up and engineered to handle it, right? I can't change my business overnight, and to do it is going to erode my revenue, right? And so if I'm a public company, how do I go to the street and tell them that next year I'm actually going to do half the revenue, but not to worry, it's subscription, so I'll get it back in 2 years, right? You try to have that discussion with an institutional investor. So it's those sorts of things, right, that pose an innovator's dilemma, and you'll find them in selective markets. You oftentimes, in the consumer context, hear it around things that Google might face, right, or problems that Yahoo might face in shifting their business model, right? That would be another example. But you got to think about kind of where it is that the incumbent can't follow you because of some structural reason. All right, so what I thought I'd do next is just spend a little bit of time talking about the venture kind of financing process a little bit. So once we've gone through this exercise of what is the value proposition, I've now sort of built out the business plan based on that, right? How do I turn that into something that I can go talk to investors about? And the first step of that, I think, is to write the investor pitch. The investor presentation has roughly these 8 sections to it. If you think about it, it should map pretty well to what you'd put into a business plan if anyone actually wrote a business plan anymore, right? Instead, everyone puts it into PowerPoint and it becomes this document. These are sort of the 8 key elements. It needs to be roughly 15 to 20 slides. And the trick here is sort of hold yourself to that, right? Resist the temptation to double that or triple that. I can't tell you the number of pitches that have come in that have 80 slides. And when you actually go through it, 78 of them talk about the great technology, and 2 of them tell me about all of the rest, right? So these are the 8. Make sure that they're all in there. It means that you get roughly 1 to 2 slides per topic area. Make sure to use them wisely. The key to this, right, is that it's all about the fundamentals, right? It's the core element to each of these 8 parts of the story. If you manage to entice an investor, they're going to want to know more, right? And that's okay. Remember that the investor pitch, and I'm going to make this point over and over again, it's a sales document, right? With the exception of consumers, right, and you're some sort of spontaneous purchase at point of sale or something, it's a long courting process, right? And the same thing holds true here. You're not expecting to get a check on the first meeting, right? And if you are, you ought to reset expectations. It's going to take a series of successive meetings, and so like any great sales process, you want to tease the customer a little bit, right? Tell them all the great things and get them to ask questions to get to the next level of detail. So it's fine to have more detail than these 8 slides. Put them in the appendix, right? So that when somebody asks, what about this? You can say, oh, well, I've got that answer over here, right? But keep the body of the document to the core parts of the business. So from there, I think there seems to be this desire to write executive summaries. Personally, I wouldn't bother. I think it's a colossal waste of time. I try to read them as fast as I possibly can, not because I'm not actually interested in the content, but I'd much rather get the investor deck that walks me through more methodically all the elements of the business. To the degree that you choose to write an executive summary, please make sure to limit it to 1 page, maybe 2. The executive summaries that run 15 pages of prose take way longer to get through, and I'm way more tired by the time I get to page 15 than if I just walked through the deck and was able to focus on the key elements that I cared about understanding. So if you're going to do the executive summary, keep it short, keep it succinct, address sort of each of the major elements, but bear in mind that, again, it's a sales document, right? So you want to tease people about what is really exciting and interesting about this to get them to want to ask more questions. I won't bother going through this. This is an incredibly dense list, but this is sort of the set of questions that you would want to ask about each of the elements of the story, and make sure then that your slide deck addresses them. Because these are the questions, whether the investor actually asks them or not, these are the questions that are running through their mind, and they're mentally kind of checking them off and going, okay, well, that's not a problem. That one's one I need to understand. That's one that they got completely wrong. From my perspective, right? They're going to try to average out and weigh sort of all of these questions. And then this is sort of my checklist. So if you answer all of these questions, right, you probably have got an investor who's really interested. Now, you're going to kiss a lot of frogs along that process because someone's going to disagree with some elements of the story. But this is the set of things that they are mentally going through, right? It's the questions on the previous slide, but sort of enumerated one at a time. So I'll leave it here for just a second so you can kind of skim through it.
Just a question. We can get a copy of this presentation, right?
Certainly. So the last thing that I just wanted to talk about on the venture process was the process itself, right? So how do you actually raise venture financing? And so this is kind of the rough timeline, and I'll just kind of walk quickly through each of the steps. The first step is to somehow contact the venture firm, and here you want to make sure to get a personal introduction if you can, right? Just to give you sort of a sense of the numbers, as a partnership, we look at about 6,000 investment opportunities a year. I personally look at between 800 and 900 investments a year. So now you start to do the math. That means that I'm looking at roughly 3 to 4 investment opportunities per day, right? Of those, I'm going to take meetings with about 120 companies, right? So about one every other day. And of those 120, I'm going to take second meetings with 40. And of those second meetings, I will ultimately invest in 1. So I had to go from 800 to 1. Right? It is a very steep winnowing process. That doesn't mean that the other 799 are bad businesses, right? It's for whatever reason it didn't capture my attention and my interest, right, along one of these dimensions, because I have to go through this process of figuring out what one do I care about. And so now if you map that into this timeline, well, how do you maximize your chance of success? Well, at the first step, you just need to get to a meeting, right? It's you want to get from the introduction to a meeting. And how do you maximize your chance of that? Well, you make sure that it's the strongest relationship you possibly can get is the original introduction, right? So as an example, if a CEO who I've backed multiple times and has been successful for me writes to me and says, here's this company, you absolutely need to take a look at it. It's the greatest thing since sliced bread, right? I'll guarantee you that I'm going to clear my schedule the next day and we're going to have time for coffee, right? To the other end of the extreme, over the transom, haven't had a chance to meet you before, I absolutely will read your presentation. All right? I make sure that I get through every single presentation that ever gets sent to me. But it means that I may not give it as much attention, right? And it means that the bar to get over is just higher. So my recommendation to entrepreneurs is find a personal relationship that gets you the original introduction and try to reach the person at the venture firm who knows that domain. Right? So if you show up and say, Tom, I want to talk to you about a clean tech deal, right? That's not my area. I just, it's an interesting space. I think it's awesome. But I have partners that know the clean tech space. That's not my thing. And the same thing holds true across most firms. So you want to identify the person that is relevant to the type of business that you are looking to start. Second step is the initial presentation. So the way these work is you come in and you pitch for an hour. We tell you it is an hour. The little secret is we almost always hold 90 minutes on our calendar. The 60-minute pitch needs to walk through those 20 slides. You want to expect that half the time will be spent with questions. Half of our questions will be things that you've actually answered in the slide deck, but you just answered them in a different order, and we asked you when we thought of them. The other half are just completely ludicrous questions that are either because we know the domain and we want to just skip through 15 of the slides because we already know the answers on the 15, and we want to get back to that part that really makes you different versus the other 10. Or I'm just out to lunch and I have, I don't understand your business yet, and so I ask some silly question. The result is you end up needing that full 60 minutes to get through your 20 slides. About half of it will be spent on the slides. About half of it will be spent answering questions. Remember, though, that the key to that first meeting, right, is not to get a term sheet, right? It's simply to get a second meeting. So what happens from there? Well, there are a series of successive meetings. Partnerships, venture firms are structured as partnerships, which means everyone in the firm sort of somehow needs to agree on an investment. Different firms have different kind of balancing acts of how many people need to agree to make a deal happen. But generally speaking, it's some sort of consensus. And so the process means that you need to meet with a number of different partners in the firm to start building consensus that this is a prospective investment that you want to pursue. So hopefully, if things go well, you'll get invited back to a series of successive meetings. That could be a couple of meetings. That could be 5 or 6 meetings. Generally, as those meetings progress, they'll start to invite some of their experts in. Right? So I have this network of people that I know in various domains that I really trust, and so I'm likely to ask them to join some of these meetings, or I might ask you to go meet with them directly, or I might introduce you to some customer prospects that I know. Right? It's a bunch of different ways to start triangulating, is this a project, right, that I'm really excited about? And if you guys use the process well as entrepreneurs, it's actually to your advantage, right? Because you've gotten a whole lot of free networking. You've met a whole bunch of potential people that you can recruit to your company. You might have picked up some interesting customer prospects. You might have picked up some interesting partner prospects. So the process is painful. Don't get me wrong, right? I raised financing before getting on this side of the table. It's a painful process, but there's actually a lot of good learning that happens along the way. That eventually leads to the last stage of the due diligence process, or the kind of the front end process, that culminates in a partner presentation. Right? And that's sort of the final blessing. You come in, you pitch to the entire firm. Everyone in the partnership, regardless of their domain sector, generally is in attendance. And they make a thumbs up, thumbs down decision effectively at the end of the meeting. If things go well and it's thumbs up, you usually then get a term sheet within a couple of days. The term sheet is sort of the first pass at the negotiated structure of the investment. You'll have a few kind of cranks at that until you kind of agree to what the terms are. And then you enter kind of legal due diligence, right? And that part generally takes anywhere from 30 to 45 days. And at the end of that, the money is wired to you and it's in the bank, and we go from there. So that's the basic process.
Excuse me?
Yeah.
When trying to obtain funding, you will probably try to deal up with the different venture capitalists at the same time.
Yep.
Do they know about this?
Yeah, so our expectation is that you will. Our preference is that you don't. If I remove sort of my venture hat for a second and I put back on my entrepreneur hat, the guidance that I usually give is that you want to approach somewhere around half a dozen venture firms at a time. Any more than that, and you're going to be swamped with first meetings and diligence requests. Any fewer than that, and you run the risk that they fall out, right? And you sort of rinse and repeat. So you do that for the first half a dozen. If none of those germinate, you go to the next half dozen, right? And you sort of just systematically start working your way through the list.
At some point, you want to tell them that you do that. How far into the process do you consider the others? I mean, at some point, just before you write the check, you have to tell the others.
Yeah, so I mean, certainly at the time that you sign the term sheet, you would tell the other prospective investors that you're not moving forward with them. Up to that point, the expectation generally is that everyone knows that you're likely talking to other firms. The place where the discussion starts to change tenor a little bit is when one firm says, hey, look, this is something we're pretty clear we want to move forward with. We've got some process ahead of us, but this is the direction we're heading. And we're interested in syndicating risk. So most venture deals that get done today are done with at least 2 investors in the initial round. And some of that is a risk reduction strategy, right? If I can mitigate risk by sharing it with others. But the reality, the real reason to do it is you double the Rolodex, right? So if you get 2 VCs from 2 different firms, you've doubled sort of the ability to help with recruiting, with partners, with other introductions, et cetera. And so most firms have a strong bias towards syndicating with one other firm. And so somewhere in that process, there will be a discussion around, hey, who else do you think is kind of moving to the top of your list? Because we'd like to start to form a syndicate with them, right? And so that's kind of the juggling act that you have to figure out of when do you start to disclose some of those other names.
I'm just wondering, because you mentioned earlier about 70% or 75% of the company which VC invests in actually today. So I'm just wondering, what is the percentage of the company that you have invested in which is successful?
Yeah, so it varies widely by firm. And sort of how you define success obviously colors that discussion. For most venture firms, they find somewhere around a 30% flat-out mortality rate, i.e. zero or asset value of some sort. They'll find another sort of 30 to 40% that returns, call it 1x to maybe 3x their money, which 3 times your money in the public markets today sounds fantastic. But for venture guys is not considered a successful outcome particularly. It's not a bad outcome, but it's not a good one either. And then the remaining ones are the 10x plus sort of returns, right? And so your hope in structuring a fund is that you will get a few of sort of the outsized returns. You get a bunch that are sort of okay returns, and then you try to get the fewest number possible that are just flat out zeros. Yeah.
How much should you be asking for typically, and how much are you giving up?
Good question. So what does the cap table look like effectively? So the Series A cap tables actually don't deviate a whole lot. As much consternation as there seems to be on both sides of the table around what does valuation need to look like, the reality is the cap table almost always looks the same. It's 30% to the founders, 20% option pool for new employees, 25% for venture investor number 1, 25% for venture investor number 2. Now, you will see some skewing of that in both directions, depending largely on the quality of the project, right? And this goes back to kind of your earlier question around how far do you have to get it to get venture financing. The further along you are, the more favorably those numbers will skew toward you and toward the rest of the employee base. The earlier you are, the more it will skew toward the favor of the investors. But as a rough order, that's kind of the typical kind of Series A structure.
How much money are you getting for that?
Yeah, so anywhere from 3 to 6 million.
So it's 30, 20, 25, 25?
Yes.
What were those for?
30% founders, 20% management team, 25% venture investor 1, 25% venture investor number 2.
You always have to start with an angel at a smaller amount first, or are you willing to look at,
Yeah, so venture firms will look at anything. There are pros and cons to raising angel financing. The advantage, obviously, is that you get capital into the company sooner, perhaps before it is mature enough that it would attract an institutional venture investor. You also will sometimes get some of the fame and notoriety associated with that angel investor, particularly if they're going to be actively involved in the company somehow. The downside is that generally they're paid pretty well for that, right? So if the call it 30 to 60% mortality rate for venture guys sounds high, it is significantly higher for angel investors, and so they oftentimes will extract greater value for that early investment. So that's the trade-off that you have to worry about as an entrepreneur. Yeah.
You mentioned the importance of getting a personal introduction, and now we have to find 6 personal introductions. Is there like a particular bar in Palo Alto?
Yeah. So we're generally pretty approachable people. So you can find us at all sorts of conferences and events, right? Remember, our job at the end of the day is to find great companies. And the dirty little secret to the venture business is there are much fewer, great companies than there are VCs hunting for them. And so while our job sounds quite glamorous, the reality is it's not.
You're not really looking for a third party then. You're looking for an opportunity.
Well, so that may be one. The third party is by far the strongest. But those, to your point, right, are the hardest to come by. In some cases, it's serial entrepreneurs who have built relationships in the past, and so you can obviously leverage those. The other way to do it is by proxy, by finding advisors that are interesting advisors to your companies, and odds are good that good advisors in the Valley are pretty well connected to venture folks. Yeah.
Do you find you're using the same decks for Series A that you would use for the angels before, or do you customize it?
I think the decks change over time, but it changes mostly because the maturity of the business changes, and you start to fill out more of the detail around what are you going to actually go do, right? So a seed deck is probably pretty light on content beyond sort of the vision of here's what I want to go pull off, whereas a Series A deck may have more detail about what have you actually built and what do some of the customer conversations look like, right? In a Series B deck, you now probably have some customers and a product, and a Series C deck, you now actually have a lot of product and a lot of customers, and are starting to talk more about how is the model scalable, right? So the maturity of the business dictates where the focus of the content is, but the same 8 sections still apply.
We have time for one final question.
One final question.
One thing that starts to happen to startups once they get press is that they start getting lots of calls from associates at VC firms asking for information. How realistically, how should those people be handled? Because from what I've heard, very few deals are funded that come into a venture capital firm via that route.
Yeah, so there are different kind of categories of that. There are a series of firms that are and I would put, Summit and TA and others like that into the category that are really kind of private equity firms, right? And so they are generally calling actively to find generally cash flow profitable businesses that they can then invest in. That's pretty different than sort of the seed that they, heard about you at a cocktail party and know that you are, going to a GSB event and, they want to come find you there. So the first set is kind of the bifurcation between those two camps. The second piece to it, right, is sort of what is the timing that you actually want to raise financing. So don't let venture interest preempt your process. If you don't think that you're ready yet, then don't go engage with them. So some of that you need to control. In terms of should you actually respond to them or not, if you are ready to start talking to venture folks, and that's the strongest introduction you have to the firm, then by all means, right? That's better than sort of the blind email to them. But on sort of the hierarchy of categories, if your next door neighbor and best friend is a GP at that firm, right, then that's probably the person you ought to reach out to. So it's, I think, kind of timing and strength of relationship would dictate whether you should actually take it if you're in that second category. If you're in the first category and it's a profitable business, I don't think it actually matters one iota how you get in the door. They're just simply interested in whether it's a real company and whether they can make money at it.